News of temporary tariff cuts between the U.S. and China reached over the weekend. Saw U.S. assets jumping today with stocks, bond yields, the U.S. dollar and oil all climbing. Joining us to discuss is Andrew Brenner. He's head of international fixed income at NatAlliance Securities. Thanks for joining us today.
Thanks for having me.
Do you think the markets sort of underestimated the ability or willingness of the U.S. and China to make some sort of early agreement here?
Absolutely. There was no question in my mind that I thought we were set up for a fail or at least something, a push. I never expected to see the Chinese tariffs come down 90% and the U.S. tariffs come down 80%, give or take. So, no, that was a big surprise for everyone. And I think the short covering that you're seeing today that you saw, not so much overnight when the details really weren't announced, but at 3 o'clock this morning, the market just shot right up as all the details became there. So there are a lot of people that were very much surprised, us included.
How would you, or what would you say happened? How would you sort of characterize or qualify what went on behind those closed doors, if looking at it from the point of view that not much was expected?
The president's been getting a lot of pressure from retailers, from Walmart, from Target, from those that actually are having difficulty or will have difficulty getting product. There's no question about that. And I think you've seen that the Chinese factories have been shut down. The Chinese ships have been empty or just waiting for things to happen, as well as some of the very smart customs-related people had things in custom headquarters there throughout Los Angeles that hadn't qualified as to what the tariff would be yet. So I think there was a lot of pressure to get the tariffs down and to get things stabilized. At 145 and 120% respectively, there was no trading that was going to go on. So I think it's very good. And, you know, and I will tell you something else that, and I'm going to sound a little bit out of the realm in this. I think it's good for the Fed, and I think it's good for inflation. I think it's actually going to promote, whereas a lot of people say, well, the equity market's soaring today. It means the Fed's on hold for longer. I think this means the Fed can ease quicker or more quickly, because the Fed told you last week that you have both inflation has come up as well as employment, and they're both equal risks. Now I think the inflation gets dissipated quite a bit because the tariffs are not going to be anywhere near as originally expected. And I think that will allow the Fed to ease more quickly than the markets are building in right now.
That being said, this is also a 90-day pause, right? So the immediate rates of the tariffs come down on what is left, but it's a 90-day pause to assess what they want to do here. So how much confidence can you build into that?
I'd say it's probably about 70-30. They wouldn't go to this length. When you're putting an A player like Bassan out there, as well as the top Chinese official, and they're negotiating, you're basically, Bassan's representing the president, and he really is representing the president, and the head of the negotiator of China is representing Xi. So they really want this to happen. They want it to be real. And the good thing about this is I think it sets a standard for other countries to come to the table and negotiate with the U.S. more seriously than some have. So I think it's a win-win situation. But yeah, there's always that 30% chance of failure in 90 days or in 60 days. All you would need is a tweet from the president or something negative from China, and all of a sudden we could be back to square one. But I don't see that happening right now.
So, Andrew, does this sort of end the run for gold at this point, or could we see more volatility be a tailwind?
You've certainly put a lot of fear into people that the dollar is no longer going to be the world's reserve currency. Now, I don't see an alternative to that. And so I'm going to stay with the fact that we're the least dirty shirt in the laundry. But you could definitely curtail gold, maybe back down to 28.50 or something along that realm. But we hit 3,500. A lot of people seem to think we could get to 4,000. If the dollar becomes under pressure again, there's no question gold will hit new highs. But I don't see that in the near future, but I do see the potential of that.
Okay, let's talk a little bit more about a Fed decision to come. Inflation numbers will be out. We mentioned employment. Can you expand a little bit more on why you think this makes the job easier for the Fed?
Well, first of all, as far as the numbers, you're going to get CPI tomorrow and you're going to get PPI on Thursday. Both those numbers are backward looking. It's really before all the major tariff reciprocal or the tariff liberation day, if you want to call it, that has happened. So a lot of that is before that, so they're not particularly relevant. But we do see inflation coming down. We do see the price of oil coming down. So those are good things. As far as what the Fed said very clearly last week, which kind of surprised us because we really think employment is a much stronger directive for the Fed to manage than inflation. But they said that both were equal, or both were being raised in their view. And now what you had, the reason inflation's up there is because the Fed said very clearly that the tariffs that were being talked about when they came out last week or when they met last week was a lot higher than they had originally anticipated. Now the tariffs are not exactly to where the Fed anticipated, but they're a lot closer. So if you take the tariff stuff off the shelf, so to speak, and inflation gets lowered, or the outlook for inflation gets lowered, then that makes the Fed's job a lot easier. They can focus on employment, and we still think the employment in the U.S. is going in a downward trend, and the hard data is not representative of the soft data, and the rubber will hit the road on that one, and we still see a shrinking, not a recession, but a shrinking U.S. economy, and we think the Fed will react. We still are at 3 rate cuts for this year. As I walked into this room, it was 2.23 right now, down from as much as 5 the other day, but more recently closing around 3. And if anything, we would go from 3 to 4, but we're not that crazy, at least not at this point in time. So we're going to stick with 3. We think the Fed is going to start easing in July. We see it as July, September, and December. And we'll have to wait to see how the hard numbers come out.
Interesting. All right. A lot of information for us to think about. I appreciate your time on this, Andrew. Thanks for joining us. Andrew's head of international fixed income at NatAlliance Securities.